for on these moves. We're going to welcome in here Rob Haworth, U.S. Bank Wealth Management Senior Investment Strategist. Rob, I actually want to start with Nvidia, Rob. I am curious what you made of that print. Solid report, Rob. Solid guide. Clearly investors wanted to see more. What did you make of that report, Rob, and also the response to the report?
Well, I think in the response, what we saw is investors were somewhat disappointed with the beat, right? I mean, you had this beat of expectations on the Nvidia side. It's still fairly good news for the future there, but it wasn't quite as good as investors hoped. And I think the challenge is we may be moving kind of past that peak acceleration in artificial intelligence spending. And that's maybe some of the concern we're seeing here, that it just expectations won't be able to keep up with where the market is priced. And that's some of what I think we're seeing in the sell-off today between Nvidia, but also other tech names are getting hit as well. So I think we're seeing a little bit of rotation here in the market.
Is this a sea change moment then, Rob, or is that a little bit of noise for the day that's going to start to kind of wade as we get further away from last night?
Yeah, I'm not sure it's a sea change, because I think for us, we're still constructive on this space as we look out over the next couple of years. I think the question is, are we a little too overdone at the moment, maybe a little too overheated at the moment? Because as you pointed out just a minute ago, really attention is going to start to turn to the jobs report and the Fed, and what is the Fed doing, and how does that really help the rest of the economy beyond just technology and artificial intelligence.
Rob, we got the Nvidia print. We also had that GDP print this morning, Rob. I'm curious to get your take on it. Did it suggest to you, Rob, an economy that's still decent, a consumer that's still resilient?
Yeah, resilience is one word we would keep using for the consumer, especially backward looking. Tomorrow, in addition to the PCE report, right, you get personal income. So we'll get another glimpse at that consumer as we enter the third quarter, meaning July. And I think it's important that they can they continue to keep up? It's really the consumer continues to find ways to maintain spending. And part of that is we have a very low unemployment rate at 4.3%. We continue to see job growth. Jobless claims are not ticking higher, and we've had wage growth. So consumers are really still in an okay spot to spend money. There's some signs of softness, particularly in the lower income cohorts, but that's not yet really bleeding through to the overall spending levels for the economy. So it's definitely something that is going to make the Fed's job maybe a little easier as they still probably head towards cuts in September, but the consumer's maybe not as soft as people feared at the start of the month.
Did the recession come and go without us really noticing it, Rob?
Well, I really don't think we've had one in an economic sense. I mean, certainly we had last year, the first 2 quarters of 2023 were negative earnings growth years for the S&P 500. So we saw maybe an earnings recession, but I don't think we've seen a recession, and it doesn't look like we're headed into one, because the consumer came into this with a strong background in savings, low credit costs. And then we've gotten wage increases and new people in the labor force. So that's really still helping the economy as we move ahead. All that still has to work through the system.
Rob, so given that your views there on the economy, the consumer, talk about how you want to position your portfolio in the equity market.
Yeah, given that we're still constructive, even though there are some risks ahead, as we highlight, right? Federal Reserve uncertainty, we could argue maybe election uncertainty. We would still tilt a little bit towards equities rather than fixed income, not because fixed income is unattractive, but rather because we think there's still growth left in this economy. We think there's still room for improvement, particularly for this rally to broaden out away from technology, maybe defensives in the near term as interest rates really start to come down a little bit here and make it easier on the real estate, on the REITs and on the utilities. Healthcare companies probably have some room to improve. So we think there's room for people to see some improvement here. In particular, we're looking towards equal weighted S&P to get away from what's been the high flyers through the month of July and into the rest of the sectors as they hopefully gain in the year end.
That's exactly where I want to go, Rob. I know that you're like an equal weight S&P. You're also recently selling off some commodities. You're adding to duration. It's giving me a sniff of defensiveness, and I'm wondering what the primary driver is of that. What are you worried about?
Well, I think we are worried about the demand condition for commodities, right? The trend in energy has been somewhat softer. The strategic, so I think we're looking at that. But you're also seeing weakness outside the U.S., particularly China. So that's hampering some of the industrial metals trends. And then we've got ample supplies of agriculture. So that's softened the commodity story. I think the other kind of concern we have is our valuation's a little rich. Do earnings expectations for 2025 maybe need to come down a little bit? And that could dampen some enthusiasm for the broader market, but particularly the high flyers, which is why we're looking into those defensive sectors, into this kind of broadening out of the rally outside of such a concentrated focus on just technology and communication services.
Rob, you mentioned the election there. Harris, Walz, giving their first interview this evening. I'm just curious, as a strategist, how you're thinking about this, Rob. Do I need to be, as an investor, ready to tweak my portfolio depending on who wins, or no, as a long-term investor, should I look through that?
So it kind of depends on what you want to look at. For us, when we look at it out for the broad market, we really don't see a big influence in the in elections on forward returns for the S&P 500, right? There's sometimes some temporary issues, but really not big ones. Really, what we see is markets are focused closely on growth and inflation. That's really what drives markets as we move ahead. So the key, though, will be as we get to platforms, are there impacts probably at the sector level? And that's where we see more room for investors to pay attention is, does this change the prospects for for one sector or the other? And we're really waiting to see a little more, both of their platforms really in writing rather than right now in rhetoric to do some of that analysis.